The most popular video on my channel thus far has been my video on arbitrage. And the reason why I think this video has become so popular is because of this idea that arbitrage offers some sort of zero risk profit. In fact, I literally put that in the title. However, obviously, if you have any experience in financial markets, in business, or whatever it may be, you know that there is no such thing as a riskless investment. There is inherent risk in, quite frankly, everything. In fact, even hypothetically, if you had a perfect trading strategy that had a 100% win rate, there would still be risk in that strategy due to possible bugs in the software or hardware failures. Maybe the power goes out wherever your servers are hosted. Maybe the bug causes your software to buy instead of sell. Whatever it may be, there is always risk, even when it sounds perfect. However, arbitrage is certainly the closest that you can get to a riskless investment due to what the strategy is trying to do. You're trying to identify pieces of information that you are virtually certain is going to move the market in a specific way. So maybe if I'm trying to play the earnings of a specific stock, I'm going to look if they are much better than what the market expected or what the market thought was going to happen, then I could possibly buy that stock immediately when the earnings come out so that I can then profit from that move up in price that I'm virtually certain is going to happen. However, the issue with this is something called the efficient market hypothesis, which basically states that there are no more market inefficiencies. So whenever there is an earnings report that comes out, or whenever there is a new news article that comes out, there will always be someone else who is going to be much faster than you that will incorporate that new information into the price of the stock. So whatever the price of the stock is currently at is the most accurate reflection of everything, of all data possible in the public. However, as we know, this is simply not true, as I'm quite literally making a video on how you, as a retail trader or individual, can take advantage of a market inefficiency regardless of how many resources you have. Because if you're a hedge fund, right, you have virtually unlimited resources. You can get the best programmers, the smartest PhDs, whatever it may be. You have an unlimited budget. You can get the best of anything. And so when you're an individual trader, you have to compete against these people to identify these market inefficiencies. However, the interesting thing about this inefficiency that I'm going to be talking about in this video today is that, at least at the moment, there is no way for these competitors of yours, in other words, hedge funds, there's no way for these competitors to take advantage of this, at least at the moment, as the only way to take advantage of this market inefficiency is by collectively gaining data from a very large group of individuals. Every single individual, every single person watching this video, I guarantee will have at least 2 or 3 data points that they can take advantage of in utilizing this market inefficiency. And you might be wondering, well, then why am I sharing this information with you? If I truly have a profitable strategy, if I am truly able to take advantage of some sort of market inefficiency, there's no reason for me to share it because I could just start my own hedge fund. I could sell this information to a hedge fund. Why would I be telling you, the public, how to utilize this strategy? Well, the reason has to do with the fact that hedge funds can't use it as well, as the only way to actually scale this strategy is by getting information from other people. So the way that I benefit from sharing this strategy is gaining the data points from my viewers to then incorporate into my own personal trading. And in fact, if you watch until the end of this video, I will shout out an even larger community than mine. I mean, to be fair, I only have less than 100 subscribers right now, but I will be shouting out a much larger community than mine that already utilizes this strategy very, very well. They have been very profitable. I've been following along with a lot of the trades. I've been incorporating a lot of their information into my own personal trading, and I've absolutely loved it, and that is what has motivated me to make this video. So make sure to stay tuned until the end where I shout out these people so that you can join their community. Of course, it's not paid. They're not selling anything. As I mentioned before, the only way that I gain an advantage from this, and the only way that this other YouTube channel gains an advantage from this, is gaining the data points from their viewers, which you'll understand in just a second. So anyways, let's get right onto the strategies. I could talk about this all day. So what is the name of the strategy? Well, the name of the strategy is social arbitrage, and it takes advantage of one of the very basic pillars of trading that is very commonly overlooked, When people get into trading, they think that there are really two paths to go down. You have to learn about technical analysis and you have to learn about fundamental analysis. Those are the only ways that you can become profitable in trading. However, this is simply not true. In fact, while it is useful to learn how to read charts and understand what basic chart patterns are and support and resistance, etc., and while yes, it is definitely helpful to understand how to read financial statements from these companies that you're trading, the thing is, since these are such commonly studied areas within trading, there are going to be the least number of opportunities here. As a lot of these automated trading strategies, a lot of people at these hedge funds, they are already looking at these charting patterns, they are already looking at these financial statements for possible opportunities. And then this is where the efficient market hypothesis really does come in. Because at a certain point, when there are so many people who are most likely much, much smarter than you looking at the same opportunities that you're trying to find, it is much less likely that you are going to be able to find an opportunity there. And so, social arbitrage, instead of focusing on these two pillars of technical and fundamental analysis, focuses on something else, which is more your community and your social circle. And I know this sounds very basic, but social arbitrage really takes this to another step. So let me give you an example of how I utilized social arbitrage recently in order to execute a profitable trade and sort of give you more in-depth analysis of what social arbitrage is. So I personally am fairly young. My community, my social circle is young as well. And so I have a very unique opportunity in that I am able to identify trends that a lot of my younger friends are participating in. And the reason why this is such a large opportunity is because you always have to keep your competition in mind. Who am I competing against within the financial markets? Who controls a majority of the money? Well, the people I'm competing against are hedge funds. And who typically makes up a hedge fund? Well, it's going to be middle-aged men, pretty much. That's a majority of what Wall Street or finance is going to be. And so especially if you focus on more female-oriented trends, that can be extremely profitable as well. However, that's not specifically what I have in my own personal social circle. And so this was a trend recently that I was able to identify, specifically a McDonald's trade. So recently you might have heard of this collaboration that McDonald's participated in, which they've now had a subsequent collaboration as well with another artist. However, this was really their first one, their first try at this idea of collaborating for a McDonald's meal. And they did a collaboration with this artist, this rapper, Travis Scott. And they created a meal where basically they literally did not do anything new. There was no toy, there was no clothing that was included in the meal, nothing special. All they did is they took a quarter pounder, fries, and a Sprite, and they just called it the Travis Scott meal. That was the only special thing about it. So to Wall Street, to the average middle-aged man sitting at a computer or trying to code some algorithm, they're not really going to think this is very significant, at least most people, right? You're going to tend to overlook this and think, oh wow, McDonald's is doing something cool, but I don't really think it's going to move the ticker necessarily. It's not really going to move the price. However, I was starting to notice something different within my own personal social circle and my own personal community. I started to notice that the younger generation was not just taking this as another McDonald's meal. I had friends who I typically basically never see go to McDonald's, and they were going to McDonald's not just to buy this meal, but also to participate in the experience. You have to keep in mind, this was during the pandemic, or at least towards the beginning of the pandemic, where many people didn't really know what to do. So whenever there was an activity that you could safely do, you could go in your car, you could go to the nearest McDonald's, which is pretty much every single place in the United States has McDonald's near it, and you can participate in this fun activity. It was getting people to come to McDonald's who would have normally never gone to McDonald's. And not only were they going to McDonald's and purchasing this meal, but they were also posting it on social media. And that's how I was able to see that many of my friends were eating it. It wasn't just that they were telling me, oh, the Travis Scott meal is really good. It's that they were posting it on their social media with let's say, a couple hundred people also looking at it and basically promoting this meal so that more people would want to go out and try it. And not only were people posting about it, but there were also memes that started to circulate from people going to McDonald's and ordering this meal in a funny way and playing the rapper's music, etc. And these really started to catch fire. And so all of this sort of snowballed into a huge trend that I felt was not accurately reflected by the price of McDonald's at the time. And so the whole idea of a social arbitrage trade is to build a thesis on a trend that the market has not fully realized yet, so that these people that you're competing against, they don't really know yet because they don't have the same community, the same social circle that you do. So once I made this trade, I bought McDonald's, and then I was waiting for information parity to hit the market. And what is information parity? Information parity basically means that there is enough coverage of this thesis that you have that the market has now accurately priced this new trend or this new thing that you've been able to identify. So later down the line, I waited and I found this article that started to circulate where basically the Travis Scott quarter pounder is so popular that McDonald's was actually having a shortage of this burger. And if you know McDonald's, everything about McDonald's is meant to be very scalable. You never expect something to actually sell out at McDonald's. So when something does sell out, that's quite significant. And so as soon as I started to see these articles circulate, really touting the popularity of this meal, I started to see that the market was moving up a little bit because of this news. Then I was able to exit this position in profit. And so this is a perfect example of how I was able to utilize my own social circle and my own community to make a trading thesis, perform a social arbitrage trade, and then sell as soon as I felt that there was some sort of information parity in the market. And of course, this is not a riskless trade. Maybe if there had been another coronavirus breakout, the market would have moved down. Maybe if the McDonald's meal would have not been as popular as I actually thought, it could have moved down. Whatever it may be, there are always risks in this, but the whole idea is that you're trying to build a thesis so strong that it's basically equivalent to an arbitrage trade, because you know that you are seeing something that the rest of the market is not seeing. And something that you cannot underestimate is how much farther ahead of the market you can be. When you're looking at very small trends within your own local community, it can take quite a while for it to actually be accurately reflected in the markets and for people at Wall Street to actually realize what is happening. So the stronger that you can build your thesis, never be afraid that the market is not moving yet because of your thesis. Enter the position, be very confident in it, and then once you see that information parity, then you can exit. So what is this YouTube channel that has been utilizing social arbitrage very successfully? Well, first I wanted to tell you about one of the founders of this channel. His name is Camillo, and he has a very interesting story that you can see by the headline of this article. So just a little side note, he does have other ventures that he was able to succeed in outside of trading. This wasn't his main income source. I think he sold a couple of technology companies, etc. He's also made investments into startups. However, his trading has also been very successful in that, at least according to this article, he has been able to turn around $20,000 into $10 million, or at least now I think it's even at over $20 million in 3 to 4 years. And I know this sounds crazy, and as someone who likes to question everything I see, I was questioning this as well until I heard that he is going to be featured in the next Market Wizards book, which is called Unknown Market Wizards. And in fact, in order to be featured in these books, if you haven't heard of them before, it's a very popular series talking about different hedge fund managers or different very successful traders. And in fact, in order to be featured, you need to have your account audited. And so he has had his account audited to prove the returns that he's been able to achieve, which I think has averaged out to around 60% per year since he started trading. And he is going to tell a story in this book, which I am very excited to read. And so the YouTube channel itself is actually called Dumb Money. So they have a main YouTube channel And then they also have this live YouTube channel where they have live streams almost every single day now. And so these live streams are really cool because they talk about current events. They talk about updates to their current trades that they're making that they also talk about on their main channel. And the main channel is basically just an edit of their live stream videos together. So it's really cool. It's very engaging. They make it very digestible, but it's also really amazing trade ideas based on this social arbitrage strategy. Anyways, thank you all so much for watching this video. I hope you enjoyed. Make sure to like and subscribe if you'd like to see more content like this, and see you in the next one.